Okay, let's get going. Good afternoon, everybody. Thank you for coming along and welcome to the first of our two webinars on the new Charity SORP. We've got two presenters on today's webinar. So I'm Glenn Bott. I'm an associate partner in our not-for-profit team here at Cooper Parry, and I head up our charity services. And I'm joined by Andy Jones, another associate partner in our not-for-profit team. He heads up our services to the education sector. But the two of us will be your presenters for today's webinar. So what we're going to cover today, I'm going to start with a quick intro to the new Charity SORP and then take you through the SORP module of income recognition, where I'll be focusing on the changes from the old SORP, but also doing a refresher on the revenue recognition requirements for many of the various income streams that you come across in the charity world. Andy will then take you through the brand new module of lease accounting. He'll then cover the practicalities of transition to the new SORP and how you can correctly account for and disclose any adjustments arising from applying the new SORP for the first time. We'll then finish off with a Q&A session. So if anyone has any questions during the webinar, please post these in the chat function. We'll then try and get through as many of these questions as we can at the end. If we do get inundated with questions and we don't get time to get through all of them, then we will follow up with responses to those questions after the webinar. So without further ado, we'll get started. So as I said, I'm going to be covering a quick intro into the new Charity SORP. Hopefully you all know what that's about by now, and then move on to that income recognition piece. So the new Charity SORP was finally published on the 31st of October last year, and it will be effective for financial periods commencing on or after 1st of January 2026. So unless there are any short accounting periods that commence after the 1st of Jan 26, the first completed financial statements that are utilised in the new SORP are likely to be for years ending 31st of December 2026. If you're a 31st of March year end, your financial period that commences on the 1st of April 26 will be under the new SORP. So it will be your 31st of March 2027 accounts that must comply with the new SORP for the first time. The SORP itself is designed to be accessed in modules, with each module including the requirement for a particular aspect of the annual reports and the accounts, or a particular type of transaction. This is very much consistent with the old SORP, so no change there, and I quite like the module setup of the Charity SORP. There's 29 modules in total, but not all of them are relevant for all charities. In terms of the modules that have the greatest changes from the old SORP, the most significant ones are the trustees report module, which is module 1, the recognition of income, which is module 5, and then lease accounting, which is a brand new module, number 10B. Income recognition and lease accounting will be covered on today's webinar, and we will be covering the trustees report changes on our webinar, which is next week. With a bit of a plug, if you haven't already signed up to it and you'd like to attend, there are still places available, so please do. Final point before I get stuck into the detail of income is to say that today's seminar is specifically on the Charity SORP. I do know that we've got some people on the call today, some from academy sector, some from colleges, and I think even a couple of housing associations. So although these other sectors will have either their own SORP or their own accounts direction that interprets the changes within here, the underlying standards are the same. So a lot of what we cover today will be relevant for you, but you will just need to consider your own accounts directions for the sectors you work in for their own consideration of those points. So let's get going on income. As I said, income recognition is module 5 of the new SORP. And one of the key changes from the old SORP is that it now very clearly classifies income between sort of two types, exchange transactions and non-exchange transactions. So an exchange transaction is where income is received for goods or services that are supplied under contract with a third party. So ultimately, a third party is providing the charity with some funding, and in return, they are getting some goods or services back. Typical examples of exchange transactions, so these would be kind of contracts for services. So if you were a care home providing residential accommodation, an obvious example of an exchange transaction is selling of an item. So if you operated a shop in an art gallery or museum, the exchange transaction would be they give you money, you give them the book. Registration fees for courses or events, again, where someone's providing some income in exchange for a service, and things like royalties and licenses. So they're all good examples of exchange transactions that you'll come across in the charity sector. The other type are then non-exchange transactions. So this is where income that the charity receives, they're not providing kind of a direct equal value in exchange to that person that has provided the income. So obvious examples of these are things like donations. So that could be donations of money or goods or facilities or services. Things like legacies, again, when money is being given to the charity without anything direct going back to the donor in return. Another one within here is grants. Although grants can potentially be a bit of a grey area, depending on the terms and conditions that are within that grant. Is it really non-exchange, or is it that the grantor is expecting something of equal value back in return? So sometimes they can need a little bit more of a review. So the main change in the SORP under revenue is in the exchange transaction side. So it's introduced a new 5-step revenue recognition model. So step 1 is to identify whether there is a contract with a third party. So definition of a contract is an exchange arrangement that has enforceable rights and obligations on both parties. So the third party has a right or obligation to provide the funding, and then the charity has the right or obligation to provide a direct goods or service back to that third party. Step 2 is then to identify the performance obligations within that contract. So at the start of the contract, the charity has to look through that and say, well, what do we actually have to provide as part of this contract in terms of goods and services? And those goods and services will be either one particular item. So if it's providing, for using my examples from earlier, a book or something that's being sold to that third party, or it could be a series of distinct goods and services that are sort of given over time. So where you have perhaps a membership subscription that gives you rights to access grounds and buildings, the performance obligation is to provide that access over the course of that membership subscription. You could have multiple performance obligations within one contract. So if there was, say, a course that was being provided, part of the performance obligation would be to provide training materials, whereas part of it could then be delivering the actual education throughout the term of the course. And then there could be an endpoint assessment at the end. So there could be a number of different performance obligations within that one contract. Step 3 is to determine the transaction price. So this is the price of the overall contract. So basically, what's the total amount of income that the charity is expecting to receive from this exchange transaction? Step 4 is then to allocate that transaction price across the performance obligations within that agreement. So again, in some cases where it's just a very simple exchange transaction where you're receiving funding to provide one good, very easy to match that transaction price to that one good. Where there are multiple performance obligations, you then need to divide that sort of total value of the contract between those different performance obligations. And what the SORP says is that each of those distinct performance obligations need to be valued separately. It could be that when they're all combined together, the value of that is more than the contract, in which case you then kind of prorate the value of the overall contract so that you have a fair split across each of those obligations. And then the final point is then just to recognise that income as and when those various performance obligations are satisfied. So assuming you've done steps 1 to 4 correctly, number 5 should just be a case of recognising that income as and when you hit those obligations. A few other considerations around exchange transactions. So where there's unrestricted versus restricted income, the SORP says that generally exchange transactions would be unrestricted income. This is because you're being paid to provide a particular service, and they're saying restricted income comes in from trust law. So in order for something to be restricted, it has to be given by somebody, typically as a gift or as a grant, not expecting something in return, but they are saying it can only be used for a particular purpose. Exchange transactions are under a contract rather than by trust law. So the restriction term doesn't really apply to exchange transactions. What the SORP then says is any surplus that you make from that exchange transaction, you can spend on any purpose of the charity. I do say generally because there could be some terms within the contract that says if you make any surplus from this exchange transaction, that you can only apply it to a particular purpose. in which case then you may have to restrict that. But quite rare, typically where it's an exchange transaction, it would be classified as unrestricted income. The other point on here is around membership subscriptions. So membership's one of those kind of grey areas. You need to look very carefully at the terms and conditions of the membership to decide whether it should be included as a exchange transaction or a non-exchange. Where it's actually providing kind of something of equal value back to the member. And again, using my example about providing access to land and buildings and grounds, if there's a charity that looks after those, the member is getting that benefit of having that membership, and they can visit those grounds without having to pay admission charges over a period. On the other hand, a membership subscription could be more akin to a donation. If there's items within the membership and they get a quarterly newsletter or get the ability to attend an AGM, these could be considered quite sort of administrative almost, or quite minor, not really of equal value to the value of the membership, in which case it would then be considered to be a non-exchange transaction, and it would be accounted for as if it was a donation, which we'll come on to shortly. So here's an example of an exchange transaction. So we have a UK charity that owns and maintains historic building and gardens, offers an annual membership that provides unlimited access to the grounds during opening hours, a quarterly digital newsletter, and a right to attend the AGM. And then some key facts. So the annual membership fee costs £120. The membership period is a fixed period between 1st of April 26 to 31st of March 27. The membership fee is paid up front. And if you do not have a membership, then you do have to pay to access the gardens. So running through that 5-step model for the exchange transactions. So step 1 is to identify the presence of a contract. So both parties have approved the arrangement. There's rights and obligations on both parts. The member will pay the membership fee, and the charity will provide that access to the grounds for the 12 months. So there is a valid contract in place. To identify the performance obligations. So the membership listed 3 benefits to the member: the unlimited access to the grounds, the quarterly digital newsletter, and then a right to attend the AGM. So the primary benefit in the membership and what's being paid for, unless somebody really enjoys going to AGMs, the primary benefit is that access to the grounds for those 12 months. The quarterly newsletter and AGM attendance are not items that you individually value, that you'd be able to put in as a performance obligation with some sort of value to the member. So in this case, the provision of the access to the grounds is the sole performance obligation from a revenue recognition point of view. Step 3 is then to determine the transaction price. Fairly straightforward in this situation. So the membership subscription we know is £120. There's nothing variable within that. Step 4, you then allocate that transaction price to the performance obligation. Again, very easy in this scenario. I didn't deliberately pick a very easy one. The £120 is the transaction price, and there is one performance obligation, which is the provision of access to the grounds. So all of that £120 would be allocated to that access right. And then number 5 is then to recognise the income as the charity satisfies that obligation. So because the obligation here is to provide the right to visit those grounds over the year, the charity doesn't know how many times somebody is going to visit or what time of year they're going to visit. So the correct recognition criteria here would be to kind of spread it over that 12-month period. So with this, we would expect the income to be recognised over the life of the membership equally, and so that would be £10 per month to get to that total £120 that's recognised over the term of the year. Hopefully that will make sense. But moving on to non-exchange transactions. For non-exchange income, the underlying principles in the SORP have not changed dramatically. However, the new SORP does provide some clearer guidance and definitions around when income should be recognised, including whether it has any conditions or performance-related terms attached to it. So non-exchange transactions, so they can include donations of money or goods given freely to the charity by a donor. Grants can be a form of non-exchange transaction where the grant maker awards a grant but doesn't receive equal value in exchange directly. In the case of donation income, this will usually be recognised on receipt, and where you have a grant that doesn't have any performance-related conditions, income will usually be recognised when it's either received or becomes receivable. And that receivable point, that's usually when there's a formal offer of funding communicated in writing to the charity and they have a valid expectation that payment will be made, then you'd say that income is receivable. So you can recognise the income at that point. However, where a grant or any other funding is provided that contains any terms or performance-related conditions, then the charity should not be recognising that income until the terms or performance-related conditions have been satisfied. Final point on here, where income is received in advance of the performance-related conditions. So if somebody gives you a grant, it gives you the money up front, but there are some conditions within that you need to achieve before you can recognise it. That income can be deferred. So a liability will be recognised, and then you wouldn't recognise that income until those conditions have been satisfied.
Glenn,
yep.
sorry to just jump in. Sometimes the sound is just sounding like you're a little bit underwater.
Oh.
Yeah, so I don't. Sometimes it comes through really, really nicely, really, really loud and clear. But I know someone's just sort of posted a comment about it, and it sort of seems to dip in and out. So I don't know. Leaning closer to the mic or something like that. But sometimes when you sort of lean in, it feels like it's maybe a lot clearer.
Okay, there's a bit better then. Apologies to anyone who's having any sound issues. So non-exchange transactions then. So in terms of what factors could delay the timing of income recognition, which things will and will not have an impact on that ability to recognise that income. So the first one, performance-related conditions. So where the grant contains specific conditions that specify either a level of output or service has to be performed by a charity, these are performance-related conditions. So in these cases, the income should not be recognised until those specified outputs have been achieved. So that one would impact on the timing of the recognition. The second one, conditional funding. So you may be promised a grant, but this is conditional on either the charity obtaining some matched funding before they are entitled to getting this funding, or there being, as an example, some planning consent required before the donor will give you that grant to be able to spend it on the property or whatever you're doing. So again, where there is conditions attached to the funding, then these would impact on the timing of income recognition. The third one on here, so donors will sometimes provide funding, but they will specify that funding has to be spent during a particular time period. So an example of this may be that the grant's given to provide some training provision, but it has to be spent during a particular academic year or during a particular period of the year. So with this, if it specifically says that you cannot spend it until that period, then that income would also be delayed and deferred until that particular year. The next one, income being restricted. So if you receive a restricted grant that can only be used on a particular purpose, this does not create a performance-related condition. Although it guides what it can be used for, it does not set a particular output or service requirement. So in that case, it's just because it's restricted doesn't mean it shouldn't be recognised. You can still recognise that income as long as it meets the other criteria. I think you see quite often in grants that there will be conditions attached to it. Such as you need to provide a set of accounts at the end of the financial period, or you need to provide some certification of the expenditure to say what you spent the grants on. These are typically considered to be administrative requirements. These are very much within the control of the charity to do. They're not something that is an output of the services that they're due to provide as a result of that grant. So if there's only those conditions, you wouldn't hold off recognising that income until they've been done. You could still recognise the income earlier. And then the final point on here is around funding being received in advance of expenses being incurred. And this is one that we see quite often amongst our clients, where they've received a donation or a grant. It doesn't have any performance-related conditions or any other terms, but because the charity has not yet spent any funding in the current year on those services, and they're not expecting to spend anything until the next year, they look to defer that income. That's incorrect. If there's no performance-related conditions in the funding, you can recognise it fully once it becomes received or receivable, and then it would be carried forward as a fund to then be spent out of in the following year, but you would recognise that income. So that one would not impact on the timing of income recognition. So some examples of non-exchange transactions. So the first one is a simple cash donation. So a local business donates £50,000 in cash to a children's charity and specifies that the money must be used for purchasing educational materials. The charity does not plan to purchase any educational materials until the next financial year. So in terms of the considerations here, the company does not receive goods or services directly in return. Therefore, it's classified as a non-exchange transaction. There's no specified levels of output or services that come with the donation, so there's no performance-related conditions attached. It said the donation must be used to purchase educational materials, so it's a restricted donation, so it should be accounted for as a restricted fund, but that doesn't necessarily impact on the recognition of the income. And because there are no other conditions attached, it can be recognised immediately. Just because the charity hasn't spent any of the money yet and won't do until next year, this is not imposed by the donor, therefore doesn't impact on the recognition of that income. So in this case, income would be recognised fully on receipt of the donation. Next example, this is a grant funding provided to deliver an outreach programme for vulnerable adults. So a local public body has awarded a grant to a charity to deliver an outreach programme for vulnerable adults. Total value of the grant is £120,000. But it does include a condition that at least 200 outreach sessions must be run within 2 years, or the funder can claw back part of that grant. And at the end of year one, the charity has delivered 80 outreach sessions. But in terms of the considerations, the company doesn't receive goods or services directly in return, so the local public body is not receiving any benefit directly to them from this grant. So it is therefore a non-exchange transaction. There is a specified level of output or services. In this case, it's 200 outreach sessions. So there is a performance-related condition attached to the grant. At the end of year one, the charity's delivered 80 of those 200, which is 40%. So there's a partial fulfilment of the condition. And because the funder has the right to claw back that grant, so if they didn't deliver any more sessions, then 120 or 60% of that funding would be recalled. That means that in year one, you would only recognise 40% of that income. Legacies. So the new SORP has brought in some new clarifications around legacies with an aim to try and increase the consistency across legacy recognition across various charities. So with legacies, what they say now is that legacy income should be recognised when it's probable that the legacy will be received. And they give some guidance in terms of what classes it as being probable. So they say when there's an applicable grant of probate, or if you're in Scotland, a grant of confirmation has been received, that the executors have established that there are sufficient assets in the estate after settling any liabilities to be able to pay the legacy. And then finally, any conditions attached to the legacy have either been met or are within the control of the charity. So if all of those are achieved, then you say the legacy is probable it will be received. The next criteria is that the legacy income must be measured reliably. So charities would need to measure or estimate the fair value of the legacy income that is receivable based on the information that's available at that point. And if you can say that the legacy is probable, it will be received, and measure it reliably, then at that point you would recognise it. Now there is a slightly different approach that the SORP allows, where you're a charity that has a lot of legacy income. So if you have a lot of legacies, you can adopt a portfolio approach. So when you're looking at the probability of the receipt and also the value of what you receive, you can apply estimates and assumptions across a portfolio of legacies. If, as a charity, you reasonably expect that the result of doing so would not differ materially from the result as if you actually reviewed each of those legacies on an individual basis against the criteria. So where you have a lot of legacies during the year, then you've probably got some historical information in terms of how many legacies actually come through, what kind of final value you get for them. So you have to have some science behind those assumptions, but you can apply it across a portfolio rather than doing this individually. The SORP does say, though, if you have any sort of unusually large individual legacies, they shouldn't form part of that portfolio approach, and you should look at them separately to ensure they meet the criteria. Or if you only have a few legacies each year, then again, you should look at those individually rather than apply that portfolio approach. So a couple of examples on legacy income. So the first one, quite a simpler, so it's a pecuniary legacy award, and it's a charity of the 31st of March 27 year end that's receiving it. So in January 2027, before the year end, a charity is notified by solicitors that they've been named in a will for a fixed legacy of 80,000. The will is valid and uncontested, probate's been granted, and the executors have confirmed that there are sufficient assets. Payments expected in June 2027, so post year end. In terms of considerations, we know that probate's been granted, there are assets in the estate, and there's no conditions attached, so the receipt is probable. It's a fixed pecuniary legacy. It tells you how much it is, so it can be reliably measured. And even though it's not expected to be received until after the year end, this has no impact on the recognition, as at the end of the year, it has met that probable and reliably measured criteria. So then that should be recognised in full in the 31st of March 27 year end. Now, the second example is a residual legacy award. And residual legacies are one of the higher judgment areas in charity accounts. The specific details of the estate and what elements are still outstanding need to be considered on a sort of legacy by legacy basis to conclude at what stage that legacy income should be recognised. But in this example, so again, it's the same charity with the March 27 year end. Pre-year end, they're notified they've been named in a will, and they're due 20% of the residual share of the estate. So the will is valid and uncontested, and probate's been granted. However, the value of the estate hasn't yet been finalised by year end because there's a property within the estate that hasn't been sold yet, and they also need to calculate any final tax liabilities. And there's not currently a timetable for when this will be finalised. So in this case, probate's been granted and the will is uncontested. However, because that value of the estate has not yet been finalised, it can't be reliably measured. The executors have also not been able to establish whether there are sufficient assets in the estate after settling any liabilities, which are currently unknown, to be able to pay the legacy. So the receipt is not probable. So on this basis, wouldn't expect to see any legacy recognised in that 31st of March 27 year end. However, depending on the size of the potential legacy, then there may be contingent asset disclosure required, just to make sure that it is reflected within those accounts. Okay, that's the end of the income recognition module. Now I'm going to hand over to Andy. Go on to the lease accounting.
I'll just get...
I'll stop sharing.
Okay. Right. Afternoon, everyone. Great for you all to join us. So as Glenn said, my name's Andy Jones. I'm associate partner in the not-for-profit team at Cooper Parry. So I'm going to take you through the new lease accounting module that's in the SORP, which is a completely new area. Sorry if you had some sort of a few noise difficulties. Then hopefully I'm coming through loud and clear. But any problems, please just post in the chat, and Glenn shout up to me if I'm not coming through loud and clear. Right, so lease accounting.
Andy.
Sorry?
Loud and clear currently.
Great, thank you. Right, so lease accounting. So this is module 10B of the SORP, and as I've got there, it's a new section, so a brave new world of lease accounting. So essentially, what the key difference now is that there's no real distinction for accounting purposes between operating leases and finance leases. There's really just the one framework that will apply to all lease agreements. So just breaking that down a little bit more. Currently, under the old SORP or the existing SORP, essentially,
Andy,
yeah.
Sorry to interrupt. You're not sharing your screen if you need to.
with me again. Okay, hopefully that's now.
Perfect.
Perfect, right. So just to show you my nice new Brave New World slide. Right, to go back on now. So under the new SORP, under the old SORP, the existing SORP, so at the moment, for operating leases, there's no recognition of those on the balance sheet. It's all off balance sheet. You make rental payments under the lease. Those are recognised as expenditure as they're incurred, as they're paid. And any future commitments under those leases are disclosed in the notes to the accounts. That's what everyone's been used to for a long time under the existing SORP. What we've got now under the new SORP is that essentially we're going to have an asset and liability recognised on the balance sheet. Well, the asset is the right of use asset, so that's the right of use of the assets that are implicit in the lease. So land and buildings, equipment. And then obviously there's also a corresponding, or not always corresponding, but generally corresponding liability also recognised on the balance sheet. What will then happen is obviously with the right of use asset, you'll have that will be depreciated over the life of the asset. And then equally, the liability will reduce over the life of the asset as you make the lease payments, but there will also be an interest charge that flows through the accounts, which is the unwinding of the discount that's within the lease liability that you've calculated. So essentially, there will no longer be this rental charge recognised in the accounts. It's going to be replaced with this depreciation and interest charges. So that potentially has a few sort of implications in terms of the accounts, and also some of the other things that we'll talk about a little bit later in terms of sort of bank covenants, if you've got those, structure of your management accounts, reserves, things like that. But I'll come on to talk about those. Now, the good news is that there are a couple of exemptions, which is around low value assets and short-term leases. And again, I'll come on to talk a little bit around what those are and how the exemptions apply, and a little bit more detail around those. So the first thing you have to do once you've established that you've got a lease is measure the lease liability. And essentially what that is it's the present value of all the lease payments that have not yet been paid. And you're doing this at the commencement date of the lease. So you've got to go back to the whole sort of start of the lease to work this out. So it's looking at what are the present value payments not yet made. And then you're also factoring in present value of any expected payments at the end of the lease. So of any sort of residual value guarantees, or any payments that have to be factored in for terminating the lease. And also if there's any sort of options around any sort of exercise price or purchase options around the asset as well, you have to factor that into the payments and do the present value calculation. And that gives you your lease liability figure. With the payments that you factor in, obviously you've got to include any fixed payments under the lease, any variable payments where those are based on a particular index or rate, but you don't include any variable payments under the lease that might be based on sort of turnover or usage. Also, as I've said, any amounts expected to be paid under residual guarantees, any sort of purchase options, and any options around terminating the lease as well. So that's calculating the lease liability. The next thing you need to do is measuring that right of use asset. So the first thing is actually you start off with the lease liability that you've already calculated. So the present value of the payments that you're expected to make over the lease. Then there's a series of other elements that you've got to factor into the calculation. So the first is any prepaid lease payments. So any payments you made before the commencement date of the lease for that are prepaid. We have to bring those into the equation. You then also have to bring in any initial direct costs incurred in putting the lease into place. So that could be, you know, any sort of delivery costs, any installation costs, particularly if it's land and building, any costs that you may have sort of capitalised or need to sort of have paid around that in terms of sort of surveys or things like that. The next thing is also to factor in any costs that you might have to incur to dismantle, remove, or even restore that asset at the end of the lease. So commonly in leases, you know, there are make good clauses, dilapidation clauses, you know, doing refreshing the carpet and doing a repaint at the end of the lease. Again, you'll need to bring those into the equation, into the calculation. Once you've done that, you then take away if there are any lease incentives. So if the lessor has offered you any lease incentives, you know, sort of rent-free periods or other cash lease incentives, you'll need to take that off the calculation as the next step. And then the final piece that you factor in is the value of any social donations under the lease. And I'll come on to talk a bit more about the social donations a bit later, but essentially this is where you're paying a below market sort of rental for the lease, not a peppercorn or a nominal value, but a below market level. You'll need to factor that into the calculation of the cost of that right of use asset. Once you've done all that, that will give you the value of your right of use asset. Now, most leases, what we'd call basic leases, your right of use asset is probably going to equal the value of your lease liability. So it's a reasonably straightforward calculation. But obviously on much larger leases, you know, particularly perhaps land and buildings or sort of complicated equipment leases, some of these other elements are going to come into play. So it's important to make sure that you've got all the information from the agreements and any other third parties that will help you do these calculations. So you'll have those calculations. An important factor in the calculation is obviously determining the term of the lease. And this essentially begins from the commencement date of the lease, and it's when the asset is basically available for use by the charity. That's the important test, and it should also importantly include any rent-free periods under the lease. So the lease may commence on a certain date, but maybe the first 6 months are rent-free. It needs to still start from that commencement date, not from the end of that rent-free period. The other factor then, what you've got to do is work out, well, what is the period of the lease? So we know the commencement date, but obviously a lot of leases now, they'll have various break clauses. They might have termination clauses. But when you take out the lease, you know, you don't always know whether you're going to exercise one of those break clauses or not. So there is a bit of a judgment there, and it's about this reasonable certainty test. So first of all, you've got to factor in any immediate non-cancelable period under the lease. But then if there are options to extend, you know, the break clauses, you've got to apply this reasonable certainty test. So at the time you've entered into the lease, although there's a break clause after 5 years and perhaps another 5 years, you know, what's your kind of idea of your original intention? What are you reasonably certain about? So if it's land and buildings, you've taken out this lease because this is going to be your HQ for the next 20 years for the charity. So you're reasonably certain that where you've got these break clauses, you are going to occupy the lease for its full period. And then also around option to terminate periods, it's the same approach, using that reasonably certain sort of test as to whether you're going to exercise that option or not. So I suppose to kind of put that into an example, and this is kind of an example that's in the SORP. So a charity agrees to lease a building for 25 years. there are options at the end of years 10 and 20 to terminate the lease. But then the contract also affords the opportunity for the charity to extend the lease for a further 5 years. So in terms of working out this term of the lease, the first bit, the non-cancelable period, well, that's relatively straightforward. It's that first 10-year period, the first 10 years up to that first option to terminate the lease. Now applying the second point, if the trustees, kind of as I said, were reasonably certain at the point that they signed the lease that they're not going to terminate it after 10 years, they really are going to occupy it for the sort of full 20-year period, then that would be the term of your lease. It would be 20 years, because you're reasonably certain at that point in time that that's what you're going to do. Also, I guess at the same time, if the trustees were also reasonably certain that whilst they'll remain for the 20 years, they will actually also extend it for another 5 years, then again the lease term will become 25 years. So it's just important to look at those, the clauses in the lease, the break clauses, termination clauses, options to extend, and apply that reasonably certain test. The next stage is obviously the discount rate, and obviously you will have used this in doing the present value calculations of the lease payments. And this, might sound a little bit of a sort of, I guess, a trickier or complicated area, but I think in practicality, it'll probably be fairly straightforward. So there are a number of options under the SORP that you can take for determining the appropriate discount rate. So the first one is that if the lease actually has an interest rate implicit in the lease, then you must use that. Now, in practice, I don't think there'll be many interest rates implicit in the lease. You could contact the landlord, the lessor, and ask them if this is something they could share with you. And this will essentially be, the interest rate that they've kind of used in working out the rentals that they're paying you for the value of the asset. So it might be something you're able to obtain. I don't think it will be readily available in the lease documentation, but it could be something, depending on your relationship with the landlord, that you could obtain. If that's not available, then you've got two further options. You can either use an incremental borrowing rate, or you can use an obtainable borrowing rate. Now, the incremental borrowing rate is probably essentially what the SORP says is this is the rate of interest that you, as the lessee, the charity, would have to pay in order to borrow over a similar time, similar security, the amount of money necessary to obtain an asset of the similar value to the right of use asset that you've calculated. So if you've calculated a right of use asset of £1 million, what would be the interest rate of you being able to borrow funds to obtain the use of an asset of £1 million? If you've already got borrowings with the bank, this could be something that's quite easy to just ask your bank about what that would be. If you can't determine in the incremental borrowing rate, then your next option is to use the obtainable borrowing rate. And it's fairly similar to the incremental one. The obtainable borrowing rate is essentially what's the rate that you would get if you were borrowing a similar amount of money equal to the undiscounted value of the lease payments over the period of the lease. So if you had to pay, I guess, £1.5 million over the period of the lease, what would be the rate that you could get in the market to borrow that amount of funding? And again, it could be something that you can talk to your bankers about giving you an idea of what that rate could be. If you're unable to obtain either the incremental rate or the borrowing rate, then there's a specific clause for public benefit entities, so charities, that if neither of those are available, then you can use an interest rate that is the prevailing interest rate across your bank deposit accounts. So if you've got 32 day deposit accounts or 90-day deposit accounts, or a mix of those things, you can use the interest rate that would apply across those. So whatever interest rate you set in the end, you set that at the commencement of the lease, and that is the interest rate that you use to calculate the present value of the lease payments. So exemptions, as I said, there are a couple of exemptions or jail-free cards, as I call them, that it is well worth looking at when you're looking at all your agreements. Before you get into all the calculations, it's definitely worth looking at, does this lease satisfy any of the available exemptions? So the first exemption is around low value assets. Now, a low value asset is basically an asset that when it's new has a low value. Now, in the SORP, there's no actual numerical value in the SORP around what is low value, but the SORP does say that things like cars, vans, boats, I think it even mentioned tractors, large production equipment, land and buildings, they're not considered to be low value. They're not low value. So I think what the SORP's looking at here is more around smaller items, so things like laptops, iPads, phones, small office equipment. That's what the low value asset exemption is really looking at. Now, the other thing with the low value asset exemption is that particular asset that's under that lease, you've got to, you as the charity, the lessee, has to be able to benefit from that asset on its own. So, i.e., a laptop or an iPad, just an independent asset, and you can just benefit from that asset in its own right. If the asset is dependent, if it's highly dependent on or interrelated related with other assets, so if the lease specifies a lot of other interrelated assets, then these need to be considered together, and they wouldn't be able to qualify under the low value exemption. So an example could be a telephone lease where you've installed a whole sophisticated telephone network across the organization, specific phone headsets that are all interrelated to each other. They're all part of that whole network. You couldn't really sort of separate those out. They're dependent on each other. They're interrelated. You would assess that as one lease rather than saying, well, each individual item is a low value item, and therefore be able to take that exemption. So important to look through your leases to see if any would be able to take that exemption. The other point is that with low value assets, that exemption is essentially considered on a lease by lease basis. The next exemption is in terms of short-term leases. So a short-term lease is basically something that has less than 12 months from the lease commencement date. So if you basically signed a 12-month lease or a 6-month lease, that you're automatically able to take an exemption from that. A slight word of warning there is just to watch out for rolling leases. Some organisations may have or may have sort of moved into a rolling lease or have a rolling lease where essentially it's just rolling on a 12-month basis. If you've got these, then again, it's coming back to this reasonable certainty test. Although it's officially you've only got a 12-month rolling lease, if you've been on that basis for the last 10 or 15 years and you're expecting to continue that way for the next 10 or 15 years, then again, applying that reasonable certainty test, it's not really going to qualify as a short-term lease. With the short-term leases, the other option as well you've got is that where on the transition date, and the transition date being your transition date over to the new SORP. So if you're a December year end, that was actually 1st of January this year. So if at that transition date you may have an existing lease, it could have been a 10-year lease or something, but if there's less than 12 months remaining on that lease at the transition date, then that also qualifies under the short-term lease exemption as well. So definitely something to look at when you're working through your leases. And the other important thing with the short-term leases is that they can't contain any option to purchase the asset at the end of that short-term lease. And again, when you're looking at this exemption, it has to be made by class of underlying assets with similar characteristics. You have to consider those all together, not on an individual lease by lease basis. So that was just a summary of the exemptions available. You know, with leases, there's a couple of specific sort of considerations I just wanted to talk through, and particularly because we see these in the charity not-for-profit sector a lot. So the first is whether you've got a peppercorn or a nominal value lease. So that's essentially where you're paying a very low, if any, consideration for the lease. So there's no substantive consideration being paid for the lease. In that form, in that scenario, although it meets the definition of a legal form of a lease under the SORP, it's not really going to meet the definition of a lease from under Module 10B of the SORP. So you're not going to have to account for it as a lease. And I've got an example there of what that could look like. You know, in terms of the market rent of a lease might be £110,000 a year. The consideration, the lease payments that you actually make are £10 a year. But what you could actually have paid for the equivalent space, as a charity, might be 72,000. That might be a more sort of reasonable figure. Then the non-exchange component that you've got here is 71,990. And in that case, what you'd be doing is recognising that £71,990 as a donation in your statement of financial activities, donated income, donated rental expense. So if you've got these in your organisation, this is probably how you're accounting for them already. So it'll essentially be no real change. The other specific one I wanted to cover was just social donation leases. And again, this is what we see across a lot of clients, a lot of charities. So again, it'll be the legal form of a lease, but again, it's not going to meet the definition of a lease under the SORP. Again, because of this, no real substantive consideration being paid. So the example we've got here is that there's, the market rent might be 110,000. The payment that you're making under the lease is £55,000 a year. Again, you worked out that what you would have paid for that equivalent space is actually £72,000 a year. So there's this social donation. You're getting, as a charity, you're getting this sort of extra discount of £17,000. So again, like in the previous example, this is the non-exchange component, and that's recognised as a donation in the statement of financial activities. Again, donated income, donated expenditure. The slight difference here, and remember when we're working through determining, what's the cost of your right of use asset, that the value of this social donation is added to the cost of your right of use asset. So if you did have this kind of structure in place, you'd find that the value of your right of use asset is going to be slightly higher than the value of your lease liability once you've worked through those calculations. Couple of just sort of presentational aspects. Once you've done all of this, you've identified what leases you've got, you've worked out what exemptions might apply. You've then done worked out your discount rate, done the calculations of your lease liability, your right of use asset, and done all the calculations, so you know what you're looking at. A couple of presentational aspects of what impact this is going to have on the accounts. So now, what you're going to have, as I said right at the beginning, you'll have an asset coming into the accounts, a right of use asset. So this is either going to be as a separate line in the balance sheet, or still within your fixed assets, but then as just a separate column within your fixed asset note, clearly showing that you have right of use assets. So that's the first thing on the balance sheet side. You're then obviously going to have the lease liability. So this is going to be a new line in your creditors note. Again, you could have a separate creditor or just as a new line in the creditors note. And also this lease liability, depending on the period of the lease, is going to be split between amounts due within 1 year and after 1 year. So again, it's going to have a little bit of an impact around sort of creditors, balance sheet, that sort of thing. So that's what the balance sheet will kind of look like. In terms of your statement of financial activities, I think, as I said at the beginning, you're going to have a depreciation charge on the right of use asset. So if you put it in really simple terms, that you worked out that the value of your right of use asset under your lease is £100,000, the lease is over 5 years, you're going to have a £20,000 depreciation charge going through your statement of financial activities each year. You're then also going to have the interest charge on the unwinding of the discounting on the lease liability. So again, if your value of your lease was also £100,000, so it was a nice basic lease, you'd have that as your lease liability. Lease liability will come down by your annual payments under the lease, but then you'll have this interest charge which is flowing through. And the way the interest charge works is that it's slightly more weighted to the earlier years of the lease. So it means that previously, under your lease, you might have been paying, in this case, you might have been paying £20,000 a year. For 5 years, £20,000. That's what you're paying under the lease. You'll have your depreciation charge of £20,000, but you're then going to have this interest charge, and that could be around £3,500 in year one. And then it'll slowly come down towards the end of the lease. But it means in that first early years, the actual charge going through your statement of financial activities is going to be slightly higher than what the actual lease payment is, or what would have been the sort of operating charge that you have under the current lease accounting rules. So again, just something to look out for in your statement of financial activities, and obviously explaining that to trustees and ensuring that they understand that. So in terms of the transition, just how you reflect all of these changes in your accounts. So as we said at the start, the SORP applies from first of accounting periods beginning on or after 1st of January 26. So it's important to understand your transition date or your transformer date. Now, for leases, there's only one option around transition, and this is applying what's called a modified retrospective approach. So what happens then is that at the transition date, so 1st of January 26, if you're a December year end, or 1st of April 26, if you're a March year end, you will have worked out what's the impact of the new requirements. Your opening reserves of that transition date are adjusted. The comparative information is not restated at all. You just do an opening reserves adjustment, and then obviously there's some additional disclosures around the change in accounting policy, how you've done the calculations, assumptions that have been used, and things like that. But essentially, comparative information isn't changed. It's just an adjustment to the reserves. And I'll come on to show you an example of what this looks like. Just going back to around revenue, with revenue, you've got two options. You've got the modified retrospective approach, or you can take a full retrospective approach, which is where you recalculate the comparative information, applying all the income recognition criteria that Glenn's worked through in relation to that prior year, and that could end up resulting in a restatement. So in that case, you don't do it as an adjustment against the opening reserves. You're doing a whole restatement of the comparative information as well. So as an example here, here's a charity that's applied the SORP from 1st of January. So what you've got here This would kind of be your funds section of your accounts. It's showing your funds as previously reported, split between your unrestricted, restricted funds. You then have your adjustments to transition adjustments from the SORP. So you'd have the recognition of your right of use asset of £150,000. This is a nice basic lease, so the recognition of the lease liability is also £150,000. And then you will have also worked out that you've got the impact of the income recognition criteria is that you've got an adjustment there for changes in income recognition for your exchange transactions of £50,000. So this is applying the modified retrospective approach. So your restated funds there are that you've got an increase to those funds of £50,000. So your unrestricted funds have increased to 800,000. Restricted stay the same, and that's your total funds. And that is how it will be presented in the funds. Moving that over to what that looks like in the statement of financial activities. Your current year activity, income, expenditure will obviously all be accounted for under the new SORP. You'll get down to your net movement in funds. And then you'll, at the bottom of the sofa, there's always the recognition of funds. So that's where you'll show the funds brought forward as previously restated. You'll have the effect of the transition to the SORP of net £50,000. That gives you your funds brought forward as restated, and then that flows through to your funds carried forward. So that's what it'll all kind of look like at the bottom of the SORP. If your right of use asset was more than your lease liability, then obviously you are going to have a positive adjustment there to your reserves as well, and that's something that's just important to understand in the context of your reserves. So in terms of an action plan, what do you do around leases now? Well, key action plan is first of all reviewing all your current operating lease agreements. Make sure that you've got all of the details on those lease agreements, the actual lease agreements, clarity around things like the lease term, the commencement dates, any break clauses, termination clauses, rent amounts, rent reviews, any discounts, any incentives that are applying under those, just that you've got the full picture of all the details of all those lease agreements. Next stage would be to assess if any of the exemptions, the low value or short-term lease exemptions would apply to any of those leases, so you can rule those ones out straight away. From there, it would then be assessing which leases will now need to be accounted for on the balance sheet. And that would mean also looking at any, as I've talked through, any sort of peppercorn nominal value leases, and also obviously any social donation leases. From there, obviously, you then got to assess the appropriate discount rate that's going to be used in those present value calculations, as I've worked through. And then you can actually do the calculations. You'll also, once you've done the calculations, some important things to consider is around any impact on any existing borrowing you've got, particularly in terms of covenants. Sometimes those covenants are based on measures like EBITDA, earnings before interest, tax, and depreciation and amortization. And what we've got here is that now, as I said, the operating lease charge is disappearing, and it's being replaced by a depreciation and interest charge. So that EBITDA measure is actually going to increase. So again, just important to understand if you have got any covenants and any existing borrowing, what impact this might be having, and ensuring that you're sort of talking to the bank around those if there is going to be any kind of adverse impact around those covenants. Next thing as well is just in terms of considering the impact around your internal reporting process and management accounts. You may need to set up new nominal accounts in your chart of accounts, and also just sort of building this into your management accounts. Now, if you've just got basic leases, then I guess and not too many of them, the differences are not going to be particularly significant. But if you do have a lot of leases, a lot of long-term leases, a lot of large value leases, then the difference between sort of that traditional operating lease charge and what you're going to see now could be quite significant. So again, you're going to have to think about the impact of that in terms of management accounts and how that's being reported, particularly if in your management accounts you're reporting sort of before depreciation and things like that. And the final aspect to consider is just around the impact on any audit thresholds, because obviously you're bringing a lot more assets onto the balance sheet. So depending on your nature, type of charity you are, but also asset levels, it could impact sort of whether if you're currently under an audit threshold, whether you suddenly exceed that audit threshold. Or it could also impact other reporting thresholds like streamlined energy carbon reporting, because again, there's criteria there around asset values and income values. And although you may currently be below the income and asset values, if there's a lot of lease value being brought onto the balance sheet, you may trigger exceeding that criteria, and that may bring you into the regime of streamlined energy carbon reporting. So again, an important consideration to look out for. And that is the end of the session on leases.
Thanks, Andy. Really useful. I've been keeping an eye on questions as they've been coming in during your session. So there are a few that we'll run through, but we have got a bit of time left. So if anyone else does have any questions at this point, then feel free to drop them in the chat or the Q&A. And so we'll try and get through as many as we can. But the first one's come through, I think, was in terms of the income recognition module. So somebody's saying they're really struggling to categorise their contracts and grants, etc. But then they say that the pictorial slides that we used were the best so far. So thank you for that comment, first of all. And as we mentioned on another question that come through, the slides will be shared after the session. So you'll have copies of those slides. I think where you're struggling to categorise contracts and grants, I mean, the examples that we've used sort of within the ones I went through were quite simple. In theory, grants and contracts normally are, but in practical terms, they can be a bit more complicated. But if there are any that you are struggling to categorise, I'd say just reach out nice and early to your advisors, your accountants, us if it's us, just to have that early conversation, because we can certainly help support with that. And the earlier the better, with the implementation date of the new SORP passed for a lot of charities now. And the sooner you can have that conversation, the sooner you can work out how you're going to recognise it. Right, I've got some on the lease side, Andy. I had one come in the chat asking if a lease for photocopiers would be considered a low value lease. What do you think on that one?
Yeah, I think it will kind of, it'll depend if it's if it's a single photocopier. Then yeah, I would say most probably, I think that you'd be able to consider that as a low value lease. It's a single asset. You can benefit from that on your own. It's certainly not one that's not considered to be low value. So I think that would meet the definition of sort of small office equipment. I think the other side could be if it was a lease of obviously a whole multitude of photocopiers across the organisation, perhaps not interrelated, but it might have been a bulk lease that's covering a number of equipments. Then I think that might be, you may not be able to take advantage of that low value exemption.
Okay. Then I had another one that come in just now, probably a similar question. What would be the situation if there was sort of a number of, there's 4 large printers all under one contract? Then would they qualify as a small office equipment, or would you consider them all as one big lease and therefore not a low value one?
I think it's much the same thing. I think it'll come back to that interrelation. Although you've got four printers, 4 printers or even 4 office, even if it was photocopiers under the one lease. Just because they're under the one lease doesn't necessarily make that not low value. If they're not interrelated, they're just separate, they're independent of each other, they can operate irrespective of each other, then I think, yes, those will be able to qualify as low value leases, would be my view.
Yeah. Had a couple come in. I'm liking the fact they're all on leases. So one come in terms of the term of the lease. So in the example that you had earlier, it had a non-cancelable element of 10 years, but then the charity had decided that they were likely to extend it at that point, and then also likely to extend it past the break clause. What about if they, at the point of going into the lease, thought they would terminate it at that first break clause of 10 years, but then 5 years into the lease, they actually said, actually, we think we're going to use the full 25 extending. What would they do at that point?
Yeah, no, good and good question, because I think this is we're going to see a lot of this, because you're having to, trustees, management team, you're going to have to make a judgment when you're doing the transition to the SORP of what's your best view, and exactly as that question is that you might say, well, actually, no, at this point in time, we're only going to occupy for 10 years, or we're going to occupy for the term, and that would and then a few years down the track, circumstances change, you'll do something different. You're just going to have to go through a process of reassessing the lease. So if there's changes to rentals or lease term or things like that, you're just going to do a reassessment of the lease. So go back through the calculations. You will have the option then also of reassessing the discount rate that you're using, because depending on how much time's moved, and obviously you'll redo the calculations, reassess the lease liability, corresponding adjustment to the right of use asset, and away you go again. It's not a new lease, you're just doing a reassessment of your existing calculations.
Yeah, very good. Had a question come in asking, for a year end August 26, how do I deal with transition? I guess with that one, for the year end August 26 accounts, you don't need to worry about it. Assuming it is a full year, you'll still be applying the old SORP for this year's particular accounts. And then for the following year accounts, for the August 27 will be where you're applying the SORP. And with that, it will be kind of as Andy went through in his transition section around identifying if there are any adjustments as a result of bringing those operating leases onto the balance sheet where you've got the operating leases, and then reviewing those income recognition requirements if there is any income that should have been recognised earlier, then making sure that that's brought in as that kind of opening balance transition adjustment. But yeah, got a little bit of time for that one, so you don't need to panic about it for this year end. And that year-end adjustment will only sort of come into those financial statements for that August 27. So you don't need to worry about it being done on the 1st of September 26 either. You've got that time to do that work and review it and complete it before the end of the following year. A question about how does materiality impact on accounting for leases? Do you want to take that one, Andy?
Yeah, well, materiality, yeah, I mean, essentially, under the SORP, you've got to apply the lease accounting rules. You've got the exemptions for your short-term leases or your low-value assets, so you can take account of that. If it's not a social donation lease or a nominal value lease, it's just a straightforward lease that doesn't otherwise meet any of those exemption criteria. Well, yes, there is always materiality. But I guess it's something, as auditors, that's going to be something that your auditors would look at if you haven't gone through that process because you've assessed that you think that lease is immaterial. I guess, we're going to look at that as auditors, and it will come down to materiality of that impact. And factors could be there that, at the transition date, it might not be less than 12 months of the lease left to go, but there might be 18 months or something like that. So, there is some sort of practical approach and materiality, but on the face of it, this applies to all charities. irrespective of what tier you're in. The only exemption is if you prepare receipts and payments accounts as a slightly smaller charity, then you don't have to worry about this at all.
Right, we do have quite a long question that's come in. So whether you want to give an immediate answer or whether it's one that we do go back to later. But there's a question about rolling agreements for leases. So in this example, they have management agreements with housing associations for some residential property use. And they collect rent and service charge, pay a management fee to the housing association, who then retain some obligations for repairs and maintenance. And these agreements have been in place for decades, but they've been recognised as operating lease obligations, as there are 6-month notice period clauses, and I'm assuming they then roll on. So the property is recognised as an asset by the housing association. But the question is, how would they calculate a present value for an agreement that has a start date before all of their current records and doesn't have a determined end date? So I guess the term of that lease is the bit that's really tricky too. Quite a specific question there, but whether there's any initial thoughts?
Yeah, it might be one we just sort of pick up and answer separately. But I mean, one of the things with the leases that is important to distinguish is whether it's actually a lease or whether what you've got is more a right of occupancy. So in particular, I know with some student unions, they just have a sort of slightly informal right of occupancy of certain premises and facilities rather than a formal lease agreement. That is kind of outside of this. So it will kind of depend on whether this is formally a lease agreement or whether it's more just a right of use, a right of access. Will be one thing to look at. Otherwise, yeah, I think a key thing is obviously making sure that you're able to get access to these agreements. Now, for a housing association, there's recently just the housing SORP has just very recently been published. So we're just working through that as well, and what the implications of that are. Obviously, they will mirror a lot of what's in the Charity SORP, but again, there should also potentially be some guidance in that SORP, potentially around that kind of scenario.
Yeah, we've just had another one drop in as well. Not the same crew, but similar, around housing associations, and they're charged by a housing association a management fee, which they say to most people, sort of third parties looking at it, would consider that to be rent that they're being charged for it. So the question is, do you follow the legal status where it's not rental income, or do you treat them as sort of in effect a rental agreement that would then be a lease that you would then bring on? But again, a similar response is looking at the terms of that individual sort of contract and taking a view on it. But yeah, we'll have a look at both of those, I think, and then come back to the people that have asked those questions just to clarify after that. I think that
I saw one other question just on leases was around whether you have to use the same discount rate on all of your leases. Basically, no, you don't. It should be essentially assessed on a lease by lease basis. So at the transition date, obviously, yes, probably the discount rate could be very similar or the same across all the leases that you're calculating at your transition date. But it is just going to be dependent on which rate you're using. If you're using the rate implicit in the lease, because the lessor can give you that information, then that's likely to vary. If you're moving more down to your obtainable or incremental borrowing rates, then potentially they're going to be similar. Or if you've gone down to the final option, which is your deposit rate, interest rate, then likely to be very similar. But going forward, as you enter into new leases in future years, you're going to have to do this calculation at the commencement date of those leases, and it's going to have to assess each lease in its own right.
Yeah. Another one's come in. Any advice on how you'd obtain a value for a nominal building lease?
Depends on the building. If you think of schools, academies, which have a nominal value, well, peppercorn. Actually, it's very hard to determine what's a market rental of that building. But so it really depends on the building. If it's more, office space, then a bit of potentially research, Googling, perhaps talking to the agent, perhaps through who you rented the property from, talking to the landlord, may be able to give you an idea of what's the market rental, the equivalent market rental in terms of what the value for what the charity could obtain for that. Again, there's going to be a judgment around that, and I think it's what you've just got to do, as long as you've applied a level of judgment to that, and it's and you've got the details of what judgment you've applied to that. That's the important thing.
Yeah. And then final question. So again, it's on leases. So is there a distinction in the SORP between a lease and a license to occupy? Because the rights of use are slightly different.
Yeah, essentially there is, and what the new SORP is looking at is essentially where there is a lease agreement more than a license to occupy. So again, that's why it's really important to look at the documentation that you've got and understand sort of, I guess, which bucket you're in. But essentially that and just working through it to see if you meet all of the criteria of essentially what a lease is. There's a really useful flow chart in the SORP of working through whether this will apply or not.
Yeah, no, definitely. Okay, I think that's it. If we have missed any, as I say, we will follow up after the webinar to make sure all of the questions are responded to. But I think we have covered all of them. But yeah, no, thank you very much for joining today. Hope you found it useful. We will share the slides afterwards, so look out for those. But yeah, thank you for attending. And so if you haven't signed up for next week and you're interested in coming to hear all about the trustees report changes, then please do come along. And if you think of any questions after the webinar, then please feel free to reach out to either me or Andy. Very happy to respond to those. So thank you for your time, and yeah, hopefully see you all soon.
Great, thank you everyone.